Okay, welcome. Let's take a look at a question that deals with cost volume profit analysis. And in this particular case, we're going to do a couple of things that you may not really need help with. But I'm wanting to make this video primarily because of this requirement C here that we have to work out. And so if you don't have any need for help on parts A and B, or then just skip in the video until you can get to part C, and we'll get you taken care of when we get there. So notice what they want. It says, what is the current break-even point in sales dollars based on the information in the scenario? And this is something that a lot of you could probably figure out without my help. B, I think you could do this as well, but just in case, I'm going to do this. It says, assuming an income tax rate of 36%, what dollar sales volume is currently required to make an after-tax profit of $700,000? And requirement C says, in the absence of income taxes, at what sales volume will both alternatives provide the same profit? And we haven't discussed the alternatives yet, but they have them right here. So one of the alternatives is going to be automation and the other is outsourcing. The good news is we can answer a good portion of this question without having to get into those two alternatives. So let's see what we've got here. They want to know the current break-even point in sales dollars. So Sweet Grove Citrus Company buys a variety of citrus fruit from growers and then processes the fruit into a product line of fresh fruit, juices, and fruit flavorings. Well, good for them. The most recent year's sales revenue was $4.2 million. Full costs were 60% of sales, and fixed costs totaled $1.3 million. And then it says Sweet Grove is evaluating two alternatives designed to enhance profitability. Okay, now I want to stop right there because I remember what they want for answer choice A, not answer choice A, but for requirement A. It says, what is the current break-even point in sales dollars? Well, all we really have to answer that question are fixed costs, which we have been provided here, $1.3 million. So you know what, I'm just going to go ahead and put that on the calculator right here. So we've got our $1.3 million. All right. Now, the other ingredient that we need here is contribution margin ratio, which is a percentage or a decimal. We haven't been provided with that, but we can get there very easily. So notice that they've given us, it says variable costs were 60% of sales. We could actually call this information right here the variable cost ratio. And the difference between sales and variable cost percentage is the contribution margin ratio. So if we were to think of sales as being 100% or 1, we could merely subtract 60 from 100, and that would give us our contribution margin. So 100% sales minus 60% variable cost gives us a leftover 40%, and we call that contribution margin ratio. I've already got my fixed cost plotted right here, so I'm just going to divide this 1.3 million by 0.4. If I do that, I come up with 3,250,000. Okay, and that's probably going to be right. So I'm going to clear this out here, and now it says assuming an income tax rate of 36%, what dollar sales volume is currently required to obtain an after-tax profit of $700,000. So if you need help with this, that's perfectly fine. I would encourage you to have some paper ready so you can pause the video and jot all this down. So what we're going to do here, it says what dollar sales volume is currently required. So we're going to have to use a variety of factors that are included. So the first thing that I want to do is I want to take this $700,000 because this is my desired after-tax profit. Okay, and I'm going to divide this by a percentage. Okay, well, what percentage? Not by 36%. If we do that, we're not going to get the right answer. So what we're going to do is kind of similar to what we did with the contribution margin ratio, where we took 1 minus the variable cost percentage. What we're going to do here is we're going to divide by 1 minus the income tax rate. And so 100 minus 36 is 64, or 0.64. So I'm going to divide that by 0.64. And I may get a messy number here if I do that. Now, not too bad at all, actually. Okay. So I took 700,000 and I divided it by 1 minus the income tax rate of and that gave me 0.64, and I'm at $1,093,750. Now my fixed costs have not changed. So now what I'm going to do is I'm going to add those fixed costs in. Okay. And at this point, I'm at $2,393,750. How did I get there? Again, 700,000 multiplied by 1 minus the income tax rate plus fixed costs, which are provided, where are they at? Right here, $1.3 million. Okay, now, remember, up here in the requirement A, what we did, we took 1 minus the variable cost percentage, and we came up with a contribution margin of 40%. What we are now going to do is we're going to take this figure that we have on our calculator and we're going to divide by 0.4. And when we do that, we get $5,984,375. So, see, it didn't come out in cents. That's nice. I like it when that happens. Okay, so we should be good on the B requirement. Make sure that you get those steps jotted down on a piece of paper. Okay, because we did a few things there. And then it says in the absence of income taxes, so we're not going to deal with income taxes at all here. It says at what sales volume will both alternatives, automation and outsourcing, provide the same profit? Well, I don't know what they're talking about. Let's see what we're talking about up here. Aha, I see them now. It says one staff member has proposed that Sweet Grove purchase more automated processing equipment. This strategy would increase fixed costs by $200,000, but decrease variable costs to 54% of sales. They were originally 60% of sales. And so, if we think about this, this makes some level of sense, right? Our fixed costs would go up via depreciation. That's where that $200,000 would come from. But our variable costs hopefully would go down. I mean, otherwise, we have to have some kind of a trade-off. And that's probably due to increased efficiency. Looks like we've maybe got a 10% improvement. We went from 60 to 54% of sales. Okay, so I just want you to kind of understand. I know all you want is the number, the answer, But I just want you to understand that this scenario actually does make some sense here. Okay, so that looks like that's probably alternative one. It says another staff member has suggested that Sweet Grove rely more on outsourcing. Okay, so we're not going to do it at all for fruit processing. This would reduce fixed costs by $200,000, but increase variable cost to 65% of sales. Okay, so our fixed costs are going down, and that makes sense. We're certainly not acquiring any more processing equipment. We may be disposing of some, so this could actually reduce our depreciation expense. And then generally what happens when you pay someone to do something for you? It often will cost more than what you could do it for yourself. But what do you get out of the deal? Well, you don't have to do it. Okay, so ultimately this company is going to select through a combination of quantitative and qualitative considerations what's best for them. But right now, that's not the question. We want to know, we're basically looking for an intersect point. That's what we're looking for. Because it says, in the absence of income taxes, at what sales volume will both alternatives, automation and outsourcing, provide the same profit? So I've started this on on a piece of paper. So I'm going to go over there for a moment. And we've got, let's move this over here a tad bit. We've got automation and outsourcing. Okay, so you might consider setting something like this up, and then we're just going to use some very, very basic algebra to get our answer. So I'm going to just be toggling back and forth here. So first process is for automation, and so it says that fixed costs are going to go up and we're going to have variable costs go down. So this is going to impact our contribution margin ratio. And so we can pretty easily account for that. Let's see here. For automation, we have sales representing 1 minus our new variable cost. Okay. And so that's our variable portion. So we're going to be solving for X here. And we're going to add to that, hope I can remember these numbers, our original 1,300,000 plus the increase in fixed cost. Okay, so let's go back over here to the question. We already had 1.3 million in fixed costs, and we are going to incur an additional 200,000. We also have to recalculate our contribution margin, and so that's what we have here. 1 minus 4% variable cost percentage, and then we have to add to that our fixed costs. And so I want to go ahead and simplify this to 0.46x plus 1,500,000. Okay. Let's see if I can move me over here a little bit. Okay, so we've got that, and what I would probably do at this point is I would look at the outsourcing alternative, and for that we're going to reduce fixed costs, but we're going to increase variable costs to 65% of sales. So we're going to have to do the exact same thing. We're just going to set it up slightly differently. So let's take a look at what that might look like. So over here we're going to say basically 1 minus 0.65x plus our original 1.3 million minus 200,000, because in this scenario our fixed cost went down. So we can simplify that to 0.35x plus $1,100,000. And at this point, we can basically get this thing solved. Move this real quick. There. We're going to compare our new contribution margin ratios of 46 and 35% for the outsourcing, and we're going to end up with 11x over on the automation side, and then we're going to compare our fixed cost to each other, and so we're going to have $400,000 over here, and then at this point we're done, or almost done. We can take our $400,000 difference in fixed cost between the alternatives and simply divide by 0.11. And that is going to give us, bear with me one second, kind of drop that down there. What is that? 3,636,364 rounded. Okay, so let's toggle back over here and put that number in. What did I write down? 3,636,364. Okay. And so the moment of truth, see if we did it right. Hopefully we did. That way we can close out this video. Check our work, and voila, we got them all right. All right, so hopefully that helped, and stay tuned for another video.